Welcome to the Weekly Option. I'm your host, Eric, and this is not a podcast today. This is actually a training video on the basics of option trading. I'm going to discuss a few strategies that I really enjoy. Specifically, we're going to get into some of the strategies that we cover on the podcast. So each week, the Weekly Option has a podcast where I give 3 new trades, and then I also review the trades that I gave in the previous show. So unlike some of the talking head videos or news programs that you see, I actually do speak to my wins, my losses, and sometimes the losses make for the best episodes because you get to hear what type of adjustments, what type of additional trades I will make in my position to try to make sure that I still am going to make a profit or at least limit risk, limit losses. So that's it. Thank you guys so much in advance for listening, watching this video. I actually am recreating this information. This information was originally presented in a format where there were 5 shorter videos, and some people wrote me and complained about my focus on speed and getting through the content rather than really focusing on hammering in and making sure that the concepts were really fully understood. So I'm making this video as a better version of those. So I'm going to take my time and actually teach a bit in this video. And my hope is that 2 things will happen. Number 1, I'd like each of you to go ahead and subscribe to this YouTube channel. I'm wanting, this is a blatant and clear request. I'm looking for some subscribers. And on many of the slides, you'll see where I've added a please subscribe to this channel. That is there intentionally. I'd love for you to join me on this journey. I'm also going to be creating more content beyond just the weekly podcast. So I'll add in some new videos that look at actual trades during the week, Monday through Friday. So hit the subscribe button to follow along with me on that journey. And also, why don't you subscribe to the Weekly Option? The Weekly Option podcast can be found on Spotify, iTunes, Google Play/music, Podbean, Player FM. I'm on a number of different channels. The podcast has been going since March of 2018 on a weekly basis. So we have over 150 podcasts already recorded, and I'm going to keep that going. And I'd love to have you follow along with me on that journey as well. I get email from people who listen to the show. I've got a lot of good, just loyal followers, and I'd love to have you be one of those. So that's it. Let's dive into this training. And thanks again in advance for following along with me. So here's what we're going to cover in this video. First, in section 1, we're going to look at calls and puts. In section 2, we're going to look at covered calls. That's one of the main strategies, or one of the first strategies that I discuss on the show. And we're also going to talk about some covered and naked puts. Section 3, we're going to look at the basic spreads, credit spreads and debit spreads. These are the spreads that I focus on for 2 of the trades on my show. Section 4, we're getting into volatility spreads. And then in section 5, we're going to look at some actual income creating strategies that you can use in the markets to, create income and manage risk consistently. So a little bit about me. I already told you my name's Eric. I've had 20 plus years trading options. I started off on the floor of the CBOE as a floor trader. Also had a brief period where I was at the Philadelphia Stock Exchange. I went to graduate school at the University of Chicago, and then spent the next 11 years as an energy trader, working for investment banks and a couple of the largest trading firms and some actual sort of downstream large distribution networks of fuel. And then back in 2018, I started my option trading podcast, The Weekly Option. So please join me on that journey. And it showed me that, number 1, I love to teach. And so my podcast really is designed to teach you some of the trades that I'm looking at and why I'm looking at them, and also how to execute them. And as well, I love to trade. I currently also trade I trade for a cryptocurrency startup that is also has an asset management, a hedge fund division too. So I'm an active trader. I trade for my own account. I trade for the hedge fund. I've traded crypto. I've traded options. I've traded energy. I've traded stock and futures. I've traded a bunch of things, and that's why I love trading. So that's enough about me. What's more important is you and who you are. So you may be a beginner just learning options, and you've probably stumbled across some of the first option trading books that I learned from early on that talked about all of the the Greeks, and made it seem like you needed to understand the Black-Scholes formula to trade options. Maybe you're an intermediate trader. You've made some trades in options. Maybe you've made some money in options, or even lost some money in options. But either way, my goal in this video and in my podcast and with this YouTube channel is to help you get started trading, or to become a better trader than you currently are. And I'm going to share kind of my view, my mentality around options, and hopefully that'll help simplify things and make this a market that you can actually, or an asset class that you can use on a consistent basis to make money. So let's get into section number 1 on calls and puts. So what exactly are they? Well, call options give the purchaser of the option the right to buy 100 shares of the underlying stock at the strike price of the option on or before the expiration date. Right? The seller of the option, of the call option, has the obligation to sell 100 shares of stock at the strike price on or prior to the expiration date. So in general, if you buy an option, you have the right to exercise that option and pay for the underlying shares. If you sell an option, you have a call option specifically, you have the obligation to sell 100 shares or provide the 100 shares of stock at the strike price on or prior to expiration to the person to whom you sold that option. And so call options go up and they increase in value when the price of the stock or whatever asset class you're trading increases. So if you think the market is going higher, you would buy call options. If you expect it to go lower, you would sell call options. So the buyer of a call option essentially is entering a bullish position. They expect the underlying stock price to increase, and in order to profit, they need the stock price to rise more than the cost of the option plus the strike in order to make money from the purchase. And I'm going to give a real example. I'll be interspersing real examples here just so that you have a clear understanding. So here we are taking a look at the S&P 500 ETF, the spiders, SPY. S as in Sierra, P as in Papa, Y as in Yankee. Let's look at this 400 call. Calls are actually on the left side of this screen. So here's the bid ask. The bid is 153. The offer is 156. So if I'm going to buy this option, I'm going to pay the offer. So if I were to buy the 400 strike, I'm paying $1.56. Now options, equity options specifically, have a 100 multiplier, meaning that each option represents 100 shares of stock. So the price of this option isn't $1.56. It's $1.56 times 100, which is $156. So for the 400 strike with the spiders, the SPY trading at $392.64, I would pay $1.56. So I'd have to add the price of this to this strike, and that lets me know where I profit. So once the underlying goes above $400, this option becomes in the money, meaning there's intrinsic value to it. But to really profit, I need the value of the underlying stock to go above $400 plus 156, which is 401.56. From then on, I am profiting on this option. I paid money to buy it, And so I need the option to have more intrinsic value at expiration than the strike price, the stock price, the strike price plus what I paid in the option. So hopefully that's clear. Let's go back to the sheet. So what are some of the risks of buying a call option? Well, this is what the payoff graph looks like. In this example, I would have paid $1 for the 37 strike call. And I can tell because of where, how this payoff graph looks. So the purchaser of an option will never lose more than the amount paid for the option. And that's why there's a straight line at -1. If you paid $1 right from the start, you're already $1 in the hole, but that just represents what you paid for the option. It doesn't matter how low stock goes, you actually cannot lose more than that dollar that you paid. And once your strike goes in the money, now that line, that payoff graph starts to increase. And since we paid $1 for this option, we'd have to add $1 to our strike price of 37. So once we get to 38, above 38, we actually are in the money and making profit. And the owner of that call option has a limited downside but an unlimited upside. And the reason it's an unlimited upside, just to go back to this, is that in theory stock prices can go as high as they'd like, right? They can't go negative, but a stock can go from $37 all the way to $37,000. Thinking Berkshire Hathaway is one of those that has stock prices up in that range. So the owner of the call option has unlimited upside and limited downside. Now let's talk about the seller, because it's different for the seller. If you sell a call option, you're expecting the market to go lower. So it is inherently a bearish position in the underlying stock. You'll need the stock price to stay below the strike price plus that premium. So what I'm getting at is what's called a break-even price. The break-even price is the same whether you buy or sell the option. It's just that if you bought the option, you want the break-even price to be passed, and if you sell the option, you just don't want the underlying stock price to get to the break-even price. So it still comes down to the strike plus the premium that was collected for the option, for selling the option. And the seller of the option actually receives money at the start of the trade. So the buyer of the option is at a loss at the start, whereas at the start of the trade, the seller of the option is actually at profit. And as you can see from this payoff graph, this is the same position. This is $1. In this scenario, the seller would have sold that 37 strike call option for $1. And you can see for all the prices lower than $37, the seller gets to keep that full $1. Now, once 37 is passed, that option is going to have some intrinsic value all the way up to the point where the seller has had to give back or has lost that full dollar. And that point is at $38. So in this example, $38 is our break-even point. And before $38, the seller of the call option is actually still in some profit, even if it's only ends up being 10 cents. But once the underlying stock goes beyond $38, the seller of the option is taking in real losses, and will ultimately be forced to sell stock for $37, even if stock is at $40, right? So that's the way the seller of the option. So the seller of the option has unlimited risk. The seller of a call option, and it's unlimited because in theory, a stock can go up to infinity, right? And they also have, the seller of the call option has a capped upside as well, because they can never make more than the amount that they collect for selling that option. So that's it. When you buy the option, you spend the money up front, but you have an unlimited earning potential. When you sell the option, you have a limited earning potential and an unlimited amount of risk. Let's talk about put options. put options tend to be a little more confusing for people because historically we're used to rooting for the stock market to go higher. Uh, Not many retail investors or traders are comfortable shorting stock, right? And with a put option, you're essentially buying a position that shorts stock. So a put option gives the buyer the right, but not the obligation, to sell 100 shares of stock at a specified price prior to expiration of the option. And the seller of the put option has the obligation to buy 100 shares of stock at the strike price on or prior to expiration. So put options increase in value; they become more valuable as the stock price goes lower. So if you expect the price to go lower, you're probably looking to buy a put option. And one good example, because put options can be so confusing, is car insurance. So if you most people are paying for car insurance on a monthly or 6 months or annual basis. And if you never have an accident, that car insurance really didn't have any value to you. In fact, it had negative value because you paid money for it over the course of the year. But if you do have an accident, the value of your car ends up it ends up lowering, right? When you get in a car wreck, your car loses value. And suddenly that insurance policy has value. In fact, it has enough value to fix the damages in your car. So the insurance policy in and of itself, its value increases when the value of your car decreases. That's exactly like a put option. If your car never loses value due to an accident, that insurance policy was just money that you paid and you lost. You paid and you lost. But if you have an accident, and don't worry, I'm not suggesting that you guys go out and have an accident, but if you have an accident, suddenly that policy has a value to it. And the value ends up being the amount, like the difference between the value of your car today minus the, or plus the value is going to be the price of your car today, or the value of your car, and then the new value of your car, the diminished value of your car because of the accident, right? The insurance value gets your diminished value because your car got dinged or scratched or hit, and it pushes it up back to the value of that car. So hopefully that wasn't, I don't want it to be more confusing, but car insurance is one clear example of a put option because you're paying a premium for it, just like you'd be buying an option, and it only has value when your car has an accident and loses value. So hopefully that wasn't too confusing. Put options. So the buyer of a put option, right? You're expecting the market to go lower, and you want the stock price to fall more than the cost of the option minus the strike in order to make money from the purchase. This just gets back to that break-even price, and we'll cover that a little bit more in a minute. Well, right now, actually. So if you look at this graph, it looks like we've paid 50 cents for the 35 strike put option. And I know that because at values higher than 35, I've paid 50 cents, right? I'm not making money. But then all of a sudden we get to 35, and that line heading starts to go up. It starts to increase as the price of the underlying decreases. And you can see it's right around 34. It's at $34.50 that the red line, the sort of payoff of the option, crosses the zero line, and suddenly this option makes more money as the underlying goes down, right? So the owner of the put actually has a capped downside because they bought the option. So the most that they can lose is the amount that they pay for the option. Now, they also have a maximum upside, which is the strike price minus what they paid for the option. So because stock cannot go down to zero, a put option can only be worth this strike value. So in this scenario with a 35 strike, this put will never be worth more than $3,500 in real terms. Because remember, I said each option is worth 100 shares. So in real dollars, this put would never be worth more than $3,500 because that would assume that 35 strike went all the way to zero. So there were $35 of intrinsic value in this stock times 100. That's the 3,500, and you will have paid 50 cents for the put, and that's in real terms times 100, $50. So the most you could ever make on this put option is $3,450, right? Hopefully that makes a little sense. If it doesn't, this is a video, so you can always watch it again. You can rewind it. You can take notes. Sometimes just writing it out, writing these examples out on a piece of paper will help them make a little more sense to you. And let's look at the seller. So the seller of a put option actually thinks the stock price is going higher, right? Seller expects the stock price to go higher. And so ultimately they are bullish the underlying stock. And they need the stock price to stay above the strike price of the option so that they can keep the amount of money, they can keep the premium that they collected for the option. That's where their profit is. So when you sell an option, your maximum profit is the amount of money that you collected for selling the option. And the seller receives money at the start of the trade, whereas the buyer actually spends money at the start of the trade. And here's a look at that payoff graph again. So same thing. The seller sold the 35 strike option at 50 cents. So you can see above the price of $35, the seller actually is in profit. It's made 50 cents. But below 35, you get this line that starts to fall and fall and fall. And that's because the option itself is increasing in value and the seller is responsible for that value. So the seller has a capped upside, which is the amount of money they collect when they sold the option. And the seller has maximum downside risk because the stock's price cannot go lower than zero. So the good thing is that it's a defined risk, but it still can be a lot of money. And let's just take a look in real dollars of some put options. So let's look at this 390 put. So with the brokerage, typically the puts are going to be on the right-hand side. And let's see, with the 390 strike, I can buy this put. I'd be paying the offer, which is the ask. It's $3.55. So if I bought it for $3.55, then my break-even price is going to be $390 because that's the strike price, $390 minus $3.55. That's going to get me a break-even price of $386.45. So if I buy this put option, I want stock after expiration to be lower than $386.45. Now, if I sell that option and sell it for $3.55, then I'm hoping that stock is higher than $386.45. If I sold this option and the stock price was still less than $390, like let's say it was $389, so the option itself is in the money, but I sold it for $3.55. So I would actually, in the market, have to buy stock for $389. I'd still get to sell it, right, to the owner of this put at $390. So there'd still be a small loss, but I would end up still making the money because even though this would have cost me a dollar, I would have been buying stock at $390 and selling it at the market price of $389. So that would be a loss of $1, but I collected $3.55. So I would still end up locking in a $2.55 profit. So I don't know if that makes sense, but when you sell a put option, it forces you to buy stock at the price of the strike, and I would still turn around and be able to sell stock at the market value, which would be lower. It'd be $389. That's okay. That $1 loss would not be, that would be less than the amount of money that I collected when I sold this put option. So hopefully that makes a little bit of sense to you. I believe we are going to move on now to one of the first trades that we cover on the podcast each week, and that is the covered call. So, and we're going to talk about hedged, we're going to talk about puts in this one too. So if you haven't had a chance, please go ahead and take a moment to subscribe to this channel and subscribe to the podcast. You'll enjoy hearing the new trades each week that I come up with. I provide 3 new trades every week and then discuss the results of the previous week's trades. And if you subscribe to the channel, you'll be alerted when I add new option trading videos to this channel, which I'm going to do a lot more of coming up soon. So, covered call. What is a covered call? Well, a covered call is a trading strategy where you sell a call on stock that you already own. So it's a hedged short call option, and it's hedged because you already own the stock. So if you sell a call option and it goes in the money, you have to sell stock, right? But you, in this strategy, you already own stock, so it's okay. It's the risk of the stock is already covered. Now, when it works, you are able to lock in returns on a stock that you wish to exit. So let's say I decide I've owned some stock and I decide that every month I'm going to sell the 10% out of the money call option, right? So I'm able to create income on stock that's sitting in my portfolio, and that gives me a little bit of price cushion in case the stock goes lower against me. But it also and that money that I collect is what they call yield enhancement, because my yield on that actual stock is going to be higher because I'm receiving more money on the position than simply what the increase in the market is doing. But what's cool about it is that it will allow me, if it goes in the money, to sell stock and lock in a 10% gain in my underlying, and I get to keep the money that I sold the option for. Now, the biggest risk is when the price goes down, because the stock itself is not hedged, right? So the option is hedged, or the option is covered, but the stock itself is not covered. So if you already own the stock, there's no additional risk in this position. It's the same amount of risk that you had from the start. I mean, if you own the stock goes down $1, you lost $1. Stock goes up $1, you made $1. But if you sell an option against it, let's say you collected 50 cents. Stock goes down $1, you only lost 50 cents, right? But there comes a point, like if the stock continues to fall lower, the amount of money that you receive for that option just isn't going to be enough to offset the risk of that price going down. But if you own stock already, you're already assuming that risk, because it's 1-to-1. Stock goes up $1, you get $1. Stock goes down $1, you lose $1. Options are just a way, in the covered call, it's just a way to augment your yield and be able to take in some premium and protect yourself a little bit on the downside. Before we move forward on that, each week we discuss a covered call, and sometimes we're able to find positions where you can make 20%, you can make 15% in a 4-week period, and it's just the way it works sometimes with the covered call. Some stocks don't move that much. There are plenty of blue chip companies where you can make a consistent 5% yield just by selling calls against stock that you already own. So the covered call strategy can be a good one, especially if you already own the stock and intend to keep it. Let's look at a hedged put. So a hedged put is something that a lot of people don't think about, but it's buying a put as a hedge against stock that you already own. So let's say you own stock and it's been going higher, but you at some point are worried that the stock price might go lower, right? Like right now, we're at all-time highs in just about every stock and definitely in the equity indexes. So at some point, the price comes lower. It might not be this year, it might be next year or the year after, but you never know. So you want to protect yourself. And you can protect yourself by buying a put. And that way, if the stock that you own goes lower, the put is going to kick into action and make up for the losses. It's kind of like that car insurance example that we looked at last time, except the difference here is that you actually own the stock and you're looking to protect the stock with a little bit of insurance. And when it works, it allows you to keep the profit of the stock going higher, and even though you're going to be paying, you're going to be spending a little cash for that put, but you're doing so that you can limit the downside price risk. And the biggest risk is that the only risk actually in this trade is that you can lose the money that you pay, the premium that you pay for that insurance, for that put, right? So if you pay 50 cents for the put, you risk losing 50 cents. And presumably if you lose money on the option though, you probably made money in your stock. So hopefully you make more than the amount of money that you lose on the option, but the option is just there in case things don't work out the way you hope to in the underlying stock. So let's look at selling a naked put. And this is a really important one to understand. When you sell a naked put, you're selling it unhedged. You're selling a put option where you don't own any stock or another option against it. So it's just completely open. So why would you do that? Well, it allows you to buy stock at a lower price than where it's trading today. So let's say stock is trading for $100 and you're like, you know what? At $90, this stock would be a steal. You can sell the $90 put, the put with the $90 strike, and you're going to collect some money when you sell that option. And if stock goes to 101, you keep the money that you collected when you sold the put. So the good thing is you make money if the stock price goes higher. If the stock price goes from 100 all the way down to $91, it's still okay, because as long as it doesn't expire in the money, you get to keep the money and you don't have to make any move in the underlying stock. But let's say stock does go to $90. Well, you're going to have to buy that stock at the strike price, but that's okay because you felt like the stock was overvalued and you wanted to own it at a discount. So buying a put like that can be really a great way to enter a position. So the risk, of course, is that you're going to have to buy the stock at the strike price of the put option if price goes lower. So if you're trading a stock that's $25 per share and you sell the 23 strike put, when prices fall below $23 per share, you actually will own the stock for $23, but that's okay because you bought it at a 10% discount, almost a 10% discount here. So that was your goal, is to buy the stock at a lower price, and selling a naked put allows you to do that, and it allows you to get paid along the way while you do it because you're collecting those option premiums. So let's go ahead and get into section number 3. And if you haven't had a chance to subscribe to the channel, please take a moment, just click the button that says subscribe, because I'd love to have you as a member, as a subscriber. And we're also going to be adding more option videos on a daily basis to look at option trades that are available in the market that might be worth explaining or might be of value to you. So next up, we're looking at option spreads. So what is a spread? A spread is made up of two or more options. You typically have a buy and a sell of the options. They're a great way of limiting exposure in the position. And we're going to look at both call and put spreads in this video. So how do you price a spread? Well, you've got to know how to price a spread in general, just so you understand what the risk is. So you'll be buying one option and selling the other option, and the price of the spread is the difference between the two options. So here's a pricing example. Let's say you buy one XYZ December 25 call for $2, and you sell one XYZ December 30 call for $1 or at $1. The total spread price is $1, and that's $2 minus $1, right? Now, how do you value? What's the value of a spread? Well, the maximum value of a spread, it doesn't matter if it's a call spread or put spread, the maximum value is the difference between the strikes. So in this scenario, we had a $30 strike and a $25 strike price. So the $5 difference is the maximum value of the spread. And let's say you're looking to buy a call spread. That means that you're expecting the stock price to go higher, and you would look to buy the lower strike and sell the higher strike price. you would pay a premium at the start of the spread because you're buying the spread. Let's take a look at a real example. So let's go back over and look at our S&P 500 example. So here, let's look at the 393, 394 call spread, right? 393, 394 call spread. And as you can see, the 393 is offered for $4.60, offered at $4.68. And the bid on it is $4.64. Since we will be selling this, we're most likely going to be we're price takers and not price makers here. So we'd be selling $4.64. I'm sorry, we're looking at buying the spread. So we would be paying $4.68 for the 393 call, and we'd be selling the 394 call, right, at $4.06. That leaves us with a difference of 62 cents. So we would pay 62 cents to own this spread. Now, the maximum value of the spread is the difference between the strikes. So 394 minus 393 is $1. So we've paid 62 cents. The maximum value is $1. That means that our maximum gain on this spread would be 38 cents. The difference between what we paid for the spread and the maximum value of the spread, which is the difference between the strikes. Does that make sense? And more often than not, I'm looking at buying in the money spreads, but that's a whole different story. And it would be actually the opposite. Let's say we decided to sell that spread. We could sell it by selling the bid of the 393, so it would be $4.64, and then buying the offer of the 394 strike. So that's $4.64 minus $4.11. That leaves us with a price of 53 cents. If we sold this spread for 53 cents, that means that our maximum amount of money that we can make on this would be the 53 cents. Because we sold an option, the maximum amount of money that we get to make is the amount of money that we collect when we sell the option. And we would have 47 cents at risk. And that's because $1 is the maximum value of the spread. So $1 minus 53 cents is 47 cents. So we got into selling a call spread a little bit just a minute ago. So you would only sell a call spread if you expect prices to go lower or stay the same. And you would sell the lower strike. In the last example was the 393 strike. And you would buy the higher strike, and that was the 394 strike. You obviously receive money. You collect a premium at the start of the trade. So the biggest risk, right, in trading spreads is that it's going to be the maximum value, which is the difference between the strikes. So you've got the risk of buying a spread, which is the amount of money that you pay when you enter the spread. The risk of selling the spread is the difference between the strikes, which is the maximum value of the spread, minus the amount of money you collect for selling the spread. And it's going to be kind of similar with the put spread. Let's say you buy a put spread. That means that you're expecting prices to go lower. So you would buy the higher strike and sell the lower strike. So you pay a premium at the start of the trade. And the same if you sell a put spread, you're expecting stock to go higher or stay the same. This is very similar to selling a put, right? Or buying a put. If you buy a single put option, you expect stock to go lower. If you sell it, you're expecting price to go higher. So if you sell a put spread, you're selling the higher strike and buying the lower strike. And you are going to collect the premium at the start. So let's take a look at some put spreads as well. As I mentioned earlier, the puts are on the right-hand side. We're going to look at selling the 390. Well, first we'll look at buying the 390, 389 put spread. So if we buy this, we'd be buying the 390 put for $3.55 and selling the 389 put for $3.21. The difference between these is 34 cents. So we would pay 34 cents, which gives us a maximum upside gain of 66 cents if the stock price goes below $389. And how do I know that that's our maximum gain? Because the maximum value is the difference between the strikes. 390 minus 389 is $1. So we're paying 34 cents for something that has a maximum value of 66 cents. And let's just keep the same prices. Let's say we decide to sell this at 34 cents. So we collect 34 cents when we enter this trade, and that's the most we could ever make. If the stock goes lower than $389, then the maximum value of that spread is $1. We took in 34 cents. The spread's worth $1, so that means we're going to lose 66 cents, right? They're sort of the inverse of one another. So your biggest risk is of buying a spread is the amount of money that you paid. You cannot lose more money than you pay for these spreads. Just like when you buy an option, you can only lose the amount of money that you pay for the option. Now, when you sell the spread, your biggest risk is the difference between the strikes, because that's the maximum value of the spread, minus the amount of money you collect when you sold it. So that's it for those spreads. And typically when we buy a spread, we call it a debit spread. And when we sell a spread, it's a credit spread. It's a credit because we are receiving money. It's a debit because we are sending money out of our account. Now, once again, if you haven't had a chance to subscribe to the channel, please go ahead and subscribe, and definitely subscribe to both the YouTube channel and to the podcast. There should be links in the description for the podcast, but you can simply Google the Weekly Option Podcast, or even Google Option Trading Podcast, and you'll see us up towards the top. So, section 4, thank you guys for hanging on to this video, learning a little bit more about options. Like I said, I was going to take it a little slower than I did in the previous videos. So now we're going to talk about volatility spreads. And on my podcast, I actually don't use the word volatility very often because it is a mathematical concept to describe the price movement of an underlying stock. I like to keep things as simple as possible. So some of you may have gotten confused in the past with the option Greeks. I actually trade options as a retail investor without a lot of focus on the Greeks. Now, they do add some value to me, and I know them like the back of my hand because I traded on the floor of an options exchange, but I found a few things. So most retail investors, when they trade options, they actually are doing so because they want to profit from the movement in the underlying stock. So as a professional trader on the floor, my goal was always to profit on volatility. So if I wanted to profit on changes in volatility, which is, volatility goes up or down, and that affects the price of options. We'll get into that in a minute. So we would actually hedge out the stock movement, the stock price risk of the stock. So you look at something like Delta, we would cover our Delta. Delta represents the way it represents sort of the stock equivalent of your position. It tells you how the price of your option is going to change as the stock price moves. So if you have an at the money option, it's a 50 delta, and you would actually, if I bought a 50 delta call, I would sell 50 shares of stock, right? Most retail investors aren't going to do that. So if you're not going to hedge using delta, you also don't have to worry about gamma, which tells you how your delta changes, right? It's the second derivative or the third derivative of price. It's the first derivative of the delta. And then if you look at your interest rate risk, rho, that's built into the option already. And we haven't had many swings in interest rates. You don't have to worry about theta and vega because honestly, they're also built into the option. There's time value, that's theta. There's time value built into the option, and you'll see that inherently in your positions. I don't know that it's going to benefit any of our retail traders unless they are trading calendar spreads. And even then, they might not need to know the mathematical value of their theta. As well, vega. Vega volatility is built into the price of the option. But they are actually trading that stock movement. So it's less of a concern for them, for most retail investors, to know the numerical value of their Vega. So That's why I don't talk about the Greeks. I do want to discuss a couple of volatility spreads here, though, because you're probably, as a intermediate or even beginner investor, you're going to hear some of these terms like straddle and strangle, and I want you to know what they are. So that was a little long-winded. Sorry about that. But what is volatility? I kind of mentioned it earlier. In layman's terms, it's a measure of the price movement of a stock during a specific time frame. So you can have 1 day volatility. You can have 1 week volatility. A lot of people will look at monthly volatility or implied volatility that's built into an option, or annualized volatility, which goes into the pricing of a stock. But it is definitely one of the most misunderstood and miscalculated often values in all of finance. So how does volatility affect options? Well, as volatility increases, it increases the likelihood that your option is going to reach its strike price. So let's say you own an out-of-the-money option. As the stock moves around up and down a lot more, it just increases the likelihood that it's going to reach the strike price that you own. So increases in volatility increase the value of options, and decreases decrease the value of options. Both calls and puts, actually. So what are volatility spreads? Well, volatility spreads are spreads that are designed to isolate for the effects of volatility. The main volatility spreads are straddles and strangles. So these are terms that you might end up hearing, and I want you to understand what they are. These are definitely volatility spreads. There are others out there as well, but these are the two that we're going to focus on today. So what's a straddle? Well, a straddle consists of a call and put at the same strike in the same expiration month. You would be buying both if you're buying the straddle, and selling both if you're selling the straddle. So here's a payoff graph of a straddle. And as a side note, I have an Excel sheet that prices and values these option payoffs. It's an option payoff graph visualization. It allows me to have a better understanding of my risk when I'm trading. So I do use this in my actual trades, just so that I always know where my break-even points are and what the payoff graph looks like for my options. If you would like if you'd like to receive a copy, just email me. My email is eric@theweeklyoption.com. That's Eric with the C. And it's at the end of this video too, but I'll gladly email that to you so that you can have that and use it for your own option trading, or even use it to follow along with me on the show each week. So when you buy a straddle, you're buying a call and a put at the same strike in the same expiration month. They increase in value with volatility as volatility goes up, and they decrease in value if prices stay still or move very little, which is also what happens when volatility decreases. So because you're buying a straddle, your maximum risk is the price that you pay for the straddle. Now your maximum gain, it's unlimited. Because you own that call option, calls have an unlimited upside, so inherently the value of this trade to you is unlimited. The downside, of course, though, is that they're also very expensive. So in this example, you've bought the 25 strike straddle. It looks like you paid $5 for it because I can see that the break-even price is $30 and $20. So if you buy it at the money, which is $25, and you need the stock price to go above $30 or below $20 before you make money on this trade. So straddles can be really expensive, but once they go, man, they go. And here's an example of selling a straddle. So to sell a straddle, you would sell a call and a put at the same strike and in the same expiration month. Now, as volatility decreases, your short straddle will actually decrease in value, which is great because your maximum gain is the amount of money you collected when you sold it, right? Your biggest risk is actually unlimited because you're short a call option. That call option has the ability to go well beyond the break-even point. It can end up being, it can go to infinity in theory. So that's what causes the risk of the short straddle to be unlimited. But again, you're collecting, in this scenario, you're collecting $5. at $500 to sell this straddle. Now that'd be a little extreme for for a 25 strike call, but call and put. But that being said, we can look at real prices just to give you an idea of what straddles would cost. So now stock price closed at $392.64 for this ETF, but let's just look at the 393 straddle, right? So you'd be paying $4.68 for the call option, and you'd be paying $4.58 for the put option, and that is a price of $9.26. I just did that in my head, so if I'm off, forgive me, but pretty sure I can do simple math. So let's see. Your break-even price then is going to be, you want to see that you own both a call and a put option. So your call is in the money when it goes $9.26 above our strike option, which is $393. So that would be $402.26, right? 402.26. And it's also in the money. Our put option rather becomes in the money when the price goes lower than $9.26. So let's see what that is. That would be $383.74. So that's it. If the stock were to end anywhere between $383.74 and $402.26, you actually will lose money on this trade. So you need a big move to happen in order to see some profit on this straddle. And that's why I said they're very expensive, but because you own the upside on both the call and the put, they can end up making you great money as well. So let's go back to the presentation and take a look at Strangles. So Strangles are similar to straddles, except that the calls and the puts have different strikes this time, typically equidistant from the at the money, and they still are going to be in the same expiration month, and you're still going to be buying both or selling both options. So here's a look at the Strangle payoff. So buying a Strangle, you would be paying money up front, and just like all of our option examples, we pay money up front, but that ends up being our maximum loss. So you're going to have a limited loss, and your gain is going to be unlimited because, again, you own a call option that can go to infinity. As well, the put option can go all the way to zero and allow you to make a lot of money there. The good thing is that they cost less than straddles, but you still are going to be spending quite a bit of money to enter this position. And the opposite, of course, is selling a Strangle. Same thing, different strikes. You're going to be collecting money up front, and that's the maximum amount that you're going to be able to receive. That's your maximum gain. It's the value of the two options that you sell up front. Your risk is unlimited because that call can go to infinity and beyond. So let's look at an actual example. I like adding real numbers in the market just so you guys can get a better sense. So right now, stock's trading around 392.50. So let's look at 2.5 up, 2.5 down. That's going to be the 395 call and the 390 put, right? So if I bought 395 call, I'm paying $3.57. If I bought the 390 put, I'd be paying $3.55. And you can see they're very close to the same price. Surprise, surprise. So you add those up, and that's $7.12. So in order for me to make money on this trade, if I were to buy these two options, if I were to buy this Strangle, I would need for price to move by $7.12 beyond our two strikes. So on the call side, that's $7.12 plus $395. That means I need stock to move to 402.12. And on the put side, I'm going to go 390 minus our $7.12, and that gets me 382.88. Now, here's what's really funny about these two, the Straddle and the Strangle that I chose. They're very close in their range. On the Straddle, our range was $383.74 all the way to $402.26. On the Strangle, we have $402.12 all the way down to $382.88. So, coincidences? I think not. But it's just an indication. There are a lot of similarities to how these options are priced and how you value them. And so you expect them to line up similarly in some situations. Like if we were to get into butterflies and other things, they can be a great indication of whether or not a stock is out of alignment in its pricing or not. But that's not for this video, of course. But that's it. So buying a strangle, selling a strangle, there's a lot of premium involved and a lot of risk, but it still comes down to the fact that if you buy options, your risk is limited to the amount of money you pay for that option. And if you sell options, typically your risk is unlimited. So we have come to the final section. And if you have not subscribed to this channel by now, I don't know what you're waiting on. I mean, look, dive in. The water's warm. I'm going to be creating more content on a daily and weekly basis. Obviously, I'll be adding my podcasts on a weekly basis. So subscribe to the podcast. You can do that on Stitcher or Spotify or iTunes, or one of those. And you can certainly click the subscribe button here on the YouTube channel so that you see the daily video content that I'm going to be creating, or just the weekly, or however many, whatever the frequency of videos. I'll be putting up more option trading videos, most likely using real data. So last section, we are looking at income strategies. So looking at buying and versus selling options just right off the bat. So when you buy an option, you need to be correct on both the timing of the option, because there's an expiration, and you need to be right on the direction of the option. That's pretty difficult sometimes. And you also are going to have to put money out right off the bat. So there's a cash outlay. Now, the good thing is that cash outlay is actually the most that you could lose on your option trade, but still you're paying money rather than bringing it in. So when I buy options, like I mentioned debit spreads earlier, when I buy spreads, I typically am buying spreads that are already in the money, because my goal is I'm hoping that stock either continues the same trend or doesn't move at all. And I'm buying something that's going to remain in the money, and I'm buying it at a discount. Now, when you sell options, it's interesting because time works for you. You want stock to sit still. You don't want any movement. And so you don't need it to move within a certain time frame. You want it to just sit still and die motionless. And you don't need a direction, right? You're hoping that there's no directional movement at all. You want stock to sit still and that option, single option or option spread, to just decrease, diminish all the way to zero. The good thing is that you also get paid right up front for the trade. So most income strategies are all about selling options in order to receive money from the start. Now, with call spreads and put spreads, buying the spreads require cash outlay. So you definitely, if you're looking for income, you're going to prefer selling them, right? And you typically are going to be, when you sell a spread, we call that a credit spread. You're going to be looking for out of the money strikes. Why would you look for out of the money strikes? Because you want stock to sit still, and your goal is to sell something that's going to decrease all the way to zero. You don't want to sell, like if you sell an in the money spread, the good thing is you're going to collect more money. The downside is that you could be exercised immediately and end up locking in a loss just with the stock value. So it doesn't make sense. You want to sell things that are out of the money and that are going to allow you to collect money up front, and ideally are going to expire worthless so that you get to keep all of that money. So let's look at right off the bat, look at one of our more complicated, but not that complicated strategies, which is iron condors. I only really leg into these on the show, meaning I don't start off with an iron condor, but I will sometimes use this as a strategy to minimize any risk of a loss on a trade. So it is an income strategy because you're receiving money right up front. So when you enter an iron condor, you're getting money. And it's a spread trade, so your downside is capped. The good thing is a spread can only be valued, the maximum value of a spread is the difference between the strikes. So your downside is capped, and it doesn't really depend on markets going up or down to work. In fact, you hope markets just sit still and expire worthless. So what is an iron condor? Well, you create it by selling a call spread and a put spread in the same underlying stock. Typically, you want the strikes to be equidistant apart to maintain a little bit of balance to the spread. But and the options do need to be in the same month, right? So same expiration month on the same stock. You're selling a call spread and a put spread. And here's a little bit of an example. So assume that XYZ stock's trading for $27.50. You're going to sell the XYZ 25/20 put spread for $1 or at $1, which means that you're buying the XYZ, you're selling the XYZ 25 put at $1.25, and you're buying the XYZ 20 put, it's a lower strike put, for 25 cents. And you're going to sell the XYZ 30/35 call spread, right? Collecting 95 cents. So you'd be selling the XYZ 30 call at $1.30, and you'd be buying the XYZ 35 call for 35 cents. So all in all, you sold a put spread at $1 and you sold a call spread at 95 cents. That means that right off the bat, you're taking in $1.95. Now, what kind of risk do you have on? Well, the maximum amount of money that you're going to get on this spread, on this trade rather, is $1.95 per iron condor that you sell. What's your maximum risk? Well, the difference between the strikes were $5 apart. You collected $1.95 to begin the trade. And the beauty of it is you sold a call spread and a put spread. At expiration, only one of those can be in the money, right? Because stock prices don't split themselves like that. Only the put can be in the money or the call can be in the money. Now, obviously, we're hoping that neither one is in the money and that stock dies right in the middle before we lose any money. But that being said, the maximum value of this trade is $5. You took in $1.95. That means the most you can lose is $3.05 on this trade. And that in and of itself right there is what makes iron condor so great. Because let's say that 10 out of 12 months you actually are able to make money on this spread. You're taking in great income, and on those other months you had a defined risk. You knew what your maximum loss was going to be. When you have a defined risk, it lets you know how many of a trade or how to value, because you're able to value the risk in the trade and you know the size of your account, you can trade in such a way that no single trade actually is going to take you out of the market. Like, one of the most important rules of trading is don't lose all your money. Simple, I know. Stupid as well. I mean, that makes it's very much intuitive. If you lose all of your capital, you no longer are trading. So don't ever bet the farm. Ever bet the farm. We used to have a rule on the floor, and that was you trade so that you live to trade another day. That means if I've got $1 million of capital, I'm not putting $1 million of capital at use, and certainly not on one trade. Like, there's a big difference between, say, like looking at options as a lotto ticket or looking at this as a consistent way to create income and create wealth. I'm hoping you're able to do the latter. If you're looking to buy a lotto ticket with these options, there's no reason for you to be watching this video. You should just go buy a call option that's out of the money, spend all of your money on it, and hey, if it goes through the strike, you're going to get multiples and you'll be a very rich person. That doesn't happen for most people, and that's why most people end up losing money trading options, right? So if you enter this with a little bit of an understanding of risk and trading intelligently by controlling risk, you're going to have a lot. I mean, the goal is for you to be able to trade long enough to understand how to trade options and then to be able to make money trading it. So don't lose all your money up front. Sorry, I'll get off my pedestal there, my soapbox. So credit spreads. A credit spread is simply a spread that we've sold. And there are many other types of credit spreads out there that I'm not talking about on this video. So I do like ratio spreads, and that's where you sell an option. You sell a closer to the money option in order to buy two or more further out of the money options, right? In that scenario, and this is actually opposite. I like doing it where I'm selling the closer to the money and buying the further away from the money options simply because it still gives me some income today, possibly some income today, but also allows me some upside, unlimited upside. And then also, of course, selling strangles and straddles, you're going to be collecting money when you sell those. Of course, you also have a lot of risks that you need to be aware of. And then there's all sorts of stuff like butterfly spreads and Christmas trees and all these other crazy option trades out there that I'm not going to get into most likely on this channel. I do teach them sometimes, but that's it really. I mean, let's look at debit spreads too. Sorry, I should mention debit spreads as an income trading spread. So the kicker with the debit spread is that you're buying the spread, and because you're buying, you have to be right on the timing and the direction. And that's why I told you earlier that I prefer in the money debit spreads that are trading for less than the total value of the spread. Meaning if I can pay 50 cents for a dollar spread, I'm going to do that all day long. And I'm going to just show you an example of this. So let's just look at this 390, 391 call spread. It's fully in the money. The S&P 500 has been ripping and warring lately. So we're creating new highs after new highs. And let's say we pay, if we're going to buy the 390, 391 call spread, we're going to pay $6.65 for that call option. We're going to, for the 390 call, we're going to sell the 391 call at $5.91, which means that we're paying a total of 74 cents for this spread. Now, that might be a little richer than I normally like to pay for these spreads. I normally don't like to go above 70 cents, but that's okay. I'm a big believer in the S&P, and I'm going to buy this in theory for this example. So you pay 74 cents. Now, I know that the maximum value of these call spreads, of this spread, is the difference between the strikes. We've got a 390 strike and a 391, so that's $1, right? So $1 minus the 74 cents we're paying is 26 cents. So 26 cents. That's my maximum gain. My maximum possible loss is selling these or buying these spreads. So I'm paying 74 cents, which means that this in theory could go down to zero. I could lose my full 74 cents. So, and there's nothing that says you have to hold on to your option spread all the way to zero. You can exit early and try and collect some money on it if it goes against you. But that being said, let's say it does go all the way. We basically will have made a 33% return on, a 33% return roughly on our money in a matter of weeks. I mean, try doing that in the stock market, right? This is why people love options. It's because you can find these trades that give you leveraged. You can get limited downside risk and still have a leveraged upside, leveraged exposure. So being able to make 33% return on your capital in a matter of 4 or 5 weeks is always going to be desirable. That's a great thing, right? It's amazing, actually. So that being said, it doesn't always work out that way. That's why it's trading. And that's why it's important to understand risk and understand what to do when this trade does go against you, if it happens to go against you. But the goal, of course, is to win more than you lose. You're going to come out doing pretty well if you do that. So key factors for trading options in general. So you need to know the break-even point. That's the point at which you are at zero. You're crossing the zero line on that payoff graph, right? You have either made money, or you're about to start making money, or you're about to start losing money. You need to know where that point is so that you can either defend your position against it, or you can be ready to lock in profit around that number as well. You need to know what your maximum risk is. If you can't quantify the amount of risk you have on, you are gambling, and at some point you will be sent home with a blown out account. Don't blow out. Live to trade another day. So it's important to know what your maximum risk is. Also, knowing your maximum risk allows you to size your trades appropriately. So if I've got $1 million, I'm not going to have $1 million at risk. So you've got to be able to quantify your risk. It's important to know what your maximum reward is. How much can you make money on? How much money can you make on the trade? Like, I'm not going to buy a 90-cent $1 spread. I'm not going to pay 90 cents for a $1 spread because all I can make is 10 cents. It's just not worth it. I'm risking 90 cents to make 10 cents. That's bad as far as I'm concerned. So you have to know what your maximum reward is, just so that you can appropriately, trade and value the trades that the market prices are showing you. And then come adjustments. So sometimes you need to adjust the trade to be able to either lock in profit or minimize the risk. And so having adjustments, understanding what the next trade is very important. So sometimes on my podcast, the best shows are the ones where my 3 trades did not go the way I wanted, because my listeners then get to hear me discuss what my next trade is. How am I going to reset this trade? Am I going to roll a strike? Am I going to create an iron condor? What am I going to do to be able to minimize my loss and keep as much capital in my account as I can? Those are the best. And sometimes that adjustment ends up leading to a profit, which is fantastic. So the goal is always maximizing profit and minimizing risk. And so having a full understanding of options is a great way to understand. You need that so that you know how to adjust the trade and alter its risk. So that's it for this presentation. If you haven't already done it, please hit the subscribe button so that you can subscribe to this YouTube channel as well. If you'd like to see all the places that we share our podcast, where we syndicate to, like iTunes, Stitcher, Spotify, Podbean, Player FM, there's a bunch of others. Go ahead and visit our website, www.theweeklyoption.com, and feel free to email me directly if you have any comments or questions. You can reach me at eric@theweeklyoption.com. That's eric@theweeklyoption.com. Also, if you'd like to get a copy of that option payoff graph that I mentioned, it's just a simple Excel file, simple math, no macros or anything. So it's easy to use, easy to email. Just send me an email and I'll get that over to you. Sometimes it takes me a little while before I send it, just because I get a lot of email from other people from the podcast, but I will send it. So that's it. Thank you so much for watching this video. And thank you, of course, for listening to the podcast.